So we will capitalize this one, and this site overheads we will add because they are on the site. They are related to the construction. But this 150, which is apportioned overhead, this we will not add because these apportioned administrative overhead, the word apportion means that these are the overheads which you are already incurring in your office, and some part you give it to it, some part you give to the building. So these are apportioned overheads. These are your existing overheads. So we will ignore it. This 150 will not come. Testing of your fire alarm system will also come. But business rates for the first year, if there is any rental charges, they are not part of the construction. Only these will be added. So when you make a total of that, it gives you answer 6950. That should be your answer. 6950, answer choice B. I just excluded two of them. Business rates, it is rent, it is operating expense. Apportioned administrative overheads, these are existing overheads. They are not related to the construction of this factory. If you have
Teacher, what is the site? What is the site overhead?
Site overhead means that any overheads which you are incurring on the site, the construction site. You know, when you make a construction, you set up some office there. In that office, you may have some, your supervisors are sitting, your project engineer is sitting. So those are your site overheads.
Yes, thank you.
So 6950 should be your answer. Very simple, short question. Number 2. This question 18 you will read. It is about your IAS 23 borrowing cost. This is from IAS 23 borrowing cost. We will do it together. First you read it, then I will explain. Borrowing cost. Okay, so what you need to do, you need to find out that how much is the borrowing cost which you will capitalize. Now, first thing is we need to find out our cost of capital, because if you understand, so let's call it average cost of debt, loans or debt, how much you have. Now you have a portfolio, you have taken two loans. One is 15 million at 9%, one is 24 million at 11%. And you have this total loan of 39 million, which is coming at two different interest rates. And from this portfolio amount you took out, it does not say that you took out 6 million at 9% or 6 million or 11%. It says that you already have these two credit lines. You already have in your portfolio, debt portfolio, these two loans. And from the mix of these two, you have taken out 6 million in the first place, and then you took 2 million again. So first we need to calculate that what is our average cost of loan. And how do I do it? I will do it like, you see, and you tell me if you understand. 15 divided by 39 multiplied by 9% plus 24 divided by 39 multiplied by 11%. Do you understand what did I do?
Yes.
Our total debt is 15 million at 9%, and then we have 24 million at 11%. And if you make a total of these two, the total is 39 million. So what I'm doing, that I say that 15 out of 39, so total is 39. So we are using proportionate method. 15 out of 39 into 9% plus 24 out of 39 into 11%. So now when I put it here, and I put here equals 2, I get my answer. It is 10.2%. It is 10.23% or 10.2%, whatever. So this is your now average cost of loan. Now you have to calculate your borrowing cost. So your borrowing cost, it says that on 1st April, it withdrew funds of 6 million on that date to fund construction. On 1st August, you took additional 2 million. So your first installment is about 6 million, right? And this period is, I will write down 6 million multiplied by 10.23%. And how many months? You are preparing your financial statements on 31st of December, and you are taking out on 1st of April. So from April to December, how many months do we have?
9.
9 divided by
10
12.
months.
So 9 divided by 12 I do. So which means that I have here, I put equals to sign. So this is 460,000. Then I make a second installment also. And second installment is about 2 million. And this 2 million was taken out on 1st of August. So August, September, October, November, December. 5 months. 5 months.
5 months.
So I make 2 million into 10.23% multiplied by 5 divided by 12. So this is the second portion of loan. So the interest cost, when I make a total of these two, it gives me 545,600. Do we have such answer? We don't. We have 544. You know what will happen? See here. Are you people with me?
Yes, sir.
You see,
Yes.
we got 545.
Yes, sir, we are.
We got 545, but we don't have any such option. Our method is correct. I only have a doubt that they are playing here. Please see, it was 10.23%. I just make it 10.2%. And here also, I just take away this 3. And now what it makes, I put here is equal to, and here I put here is equal to. Do you get the answer now?
Yes, sir.
So what do you understand? Why our answer was not correct?
Yeah, because of the nearest multiple of this that they are taking.
Yeah, because we are taking 2 decimal places. We took 10.23% and they were doing calculation with 10.2% with 1 decimal place. So if the answer is like this, you should always think like, okay, maybe I will check, maybe I'll get it here, because that was the closest answer. It could not be 472, it could not be 750. These numbers were very much far away. So I was sure that there is some very little thing. And actually what we did, 10.23 was a better thing, because in accounting and finance, usually we work with minimum 2 decimal places. Single decimal place we never work. So I don't agree what they did, but anyways, we'll go like this. I still suggest that we use 2 decimal places, because 2 decimal places will give you more accurate answer.
Yeah, for the calculation perspective, it is correct to take 2.23 because when we have a larger amount, it makes a difference for the.
It makes a big difference, yeah. It makes a big difference. So 2 decimal places is advisable. But anyways, let's do it with 1. We got the answer. We move to question number 19. Now, please read the question and then I will do myself.
Yes, sir. I'm also getting some noise, sir. If you mute everyone, then probably we'll have
Okay.
clarity.
I'll mute everyone. So I mute everybody. Thank you. Okay. So Leclerc has borrowed 2.4 million to finance the building. It's the same borrowing cost question, but in this case, what you will have your interest expense to be capitalized, but you also will have your interest income, because for some certain period you are investing these funds. So whatever are your interest expenses are there, you will minus the interest income, you will subtract the interest income and then get the answer. So it's very simple. Let's see how much is the interest expense. Jabbar, I'm muting you because there is some noise. So everybody, I'll put on mute. When you have to say something, you can unmute yourself and then you can speak. Okay, we have interest expense. So how much is the loan? The loan was about. The loan is about 2.4 million. So 2.4 million.
Loan date is 1st of July.
So
January,
you got 2.4 million of loan, which is at 8%. This is going to be your interest expense. But when did you take the loan actually?
1st January 2009.
So you are taking the loan on 1st of January. But the thing is that it says that the work began on 1st of March. So capitalization will start in March.
Yeah.
Capitalization will start in March when the construction starts. Because if the construction does not start, you cannot capitalize. You can only capitalize when your process begins. So we'll say capitalization start in March. So I will have 2.4 million multiplied by 8%, and from March until December. So January and February are not included. So 10 divided by 12 I will do. Do you understand the point?
Yes, sir.
We will have it on. What is the problem here? Okay, multiplied. So we will have here. Okay, this number is not percentages.
So, sir, all of these questions are part of section A or section
Yes.
B?
Yeah. I took from section A from your book.
Okay, sir.
So this is the interest expense, but then you also have interest income.
Sir, we can't see you today. You off your video. Okay?
Sorry?
You switched off your video. We can't see you today.
Oh, sorry. I didn't. Maybe by mistake. Do you see now?
No.
Is it shared?
Video. We means your camera.
Okay, my camera.
Yeah.
Okay.
Fine. Good to see you when you are speaking. And
Thank you very much. Okay. Yeah, it is good to see face to face.
yeah, actually we are knowing, that we are talking to somebody and he's there.
All right. Okay. So you have interest expense, which is 8%, and you capitalized for 10 months. Then you also have interest income because there is a temporary investment of these funds. The question says that you invested this money, right?
Yes.
So how much you invested and for how much period? You invested 1 million. 1 million we invested, and we invested at 6%. We invested at 6%. And when did we invest? It says that 1 million was not utilized until 1st July 2009. So now which period you should take?
So interest income is 6% for 6 months.
For 6 months, right? Which 6 months?
July to December.
No. July it was used. It says
Okay.
until July, because after July you spent this money on construction. Until July, like from the beginning period, it was free.
Okay, so 6 months it was free.
Which period? Which months?
1st January to 30th of June.
Okay. Yes, please, Emmanuel and Jabbar, please take care. Why I picked up this question? Because here where students, they make a mistake, not only in exam, but also in real life. Please understand, we took out loan on 1st of say, January here. And it says that until 1st of July, the funds were not used. 1 million was not used until 1st of July, which means your 1st of July somewhere is here. So this is the period in which you were not using the funds, okay, until this point. So you had these funds free for this period in the beginning. In the beginning, these funds were free. So you invested those funds in the beginning period of the year.
Borrowed actually.
Yeah, you invested them. So we invested them at 1 million into 6%. For which period did we invest?
For 6 months.
We had this money free with us from January to 30th of June. So it looks like that you will do it with 6 divided by 12. No, you cannot do it.
Okay.
Actually, the funds are free from January, February, March, April, May, and June. You had this 1 million. You had this 1 million extra with you. But when did you start your capitalization? Capitalization you started in March, right?
Yes, sir.
So investment income will also start from March. Okay, this is the rule.
But what if I have started investing this money from 1st of January?
I know that you might have done, but you cannot put it here. I will tell you why. First, because I just told you something which was unexpected, right? We told you something which is unexpected. You get here 20,000 and you multiply it with -1 and you get your answer. So your interest expense is 160,000. Your investment income is 20,000 based on only 4 months, and your answer is 40,000. First, you agree with that. Your answer is 140,000, and then I will explain. So we get here, our answer choice is E. Now I know that, please, I know that we had this, we had these funds available with us from January, February, March, April, May, June, 6 months. These funds, 1 million was extra with me, was spare with me. I may add it, I may have invested it. I may invested it from January for 6 months, but for the purpose of capitalization cost, from here you will only deduct this amount. Listen, I'm not stupid. I will not let this money stay away like this. I will invest my 1 million from January to 30th of June. That's for sure. I'm not going to leave this money like this. And I will earn 1 million multiplied by 6% multiplied by 6 months. Okay, that is for sure. I am going to make this income. I will not let this 1 million sit idle. I will earn this 30,000. But in borrowing cost, I will bring only for 4 months. So out of this 30,000, 20,000 I will take to borrowing cost as investment income, and 10,000 I will put in my other income, in interest income in my income statement. So I will earn 30,000, but only this 20,000 portion, this I will take, or this I can take to my borrowing cost calculation. This 10,000, which I already have earned, I'm sure I have earned, but this 10,000 I will take to my P&L as interest income. I earned it, there is no doubt. Do you understand my point, what I'm saying? And why do I do it? We did it because the interest expense capitalization started in March, and therefore your interest income, investment income will also take effect from March. That is
so, sir, is it as per the accounting standard of borrow cost, or like why we are doing this, that we are reporting 1,000, 10,000?
Okay, let me tell you why we do it. First of all, yes, it is what the standard requires. This is the rule. But as I told you in the very beginning from day one, that if anything which is written in the standard, if I cannot logically justify it, if I cannot give you a rational or a logic or a reason, then you should not believe me. It has a very straight logic. It has a logic. Because for the first 2 months, when you were not capitalizing, when did we start capitalizing? In March?
Yes, sir.
So where is the January and February interest going? January, February, you paid interest to bank. Listen, you took out loan on 1st of January, right? You took out loan from 1st of January. So January and February interest, where did it go? It go to the income statement. Let me show you. Okay, let's do this question. Let's do this question, please. We have to understand this thing with detail. So we took out loan. Our loan is for 8%, right? And we took out in January. We had February. We have March, and then April. I want to spend as much time as possible because we have to be very clear on that. June, July, August, and whatever. These are the months which are going on. I'm sorry, I have to write it down, but I want to show you the procedure. One time and last time. So this is my full 1 year. My loan is 2.4 million. Okay, 8%. So how much I'm charging the interest? Okay, let me put it here, 8%. So my interest cost is 2.4 million into 8% divided by 12. This is 1 month interest. So every month I am paying this much of interest. 16,000 is my monthly interest. We took out loan from here, but this month and this month we were not doing construction. So this interest will go to P&L, your P&L as interest expense. This also will go to P&L as interest expense. This will start capitalized. And from here until end, you will capitalize. Agree?
Yes.
Okay. Now this is about your expense. Now you have also 1 million, which you invest for 6% in the bank. So what will happen? Every month from here until here, you will get this interest income. So this is your interest expense, and here you get interest income. But this interest income,
divide by 12, divide by 12, sir.
Sorry, divided by 12. So this 5,000 is your interest income until this period, because you have only surplus funds available until June. After June, you use this money in construction and your money finished. You only had surplus funds for 6 months, because when you got 2.4 million, you purchased land with probably 1 million. Then you purchased some raw materials of 500,000 like cement or sand or whatever, and you started construction. 1 million was spare with you. This extra surplus spare 1 million remained with you for 6 months period. Now it will be very illogical. It would be very illogical if I capitalize it. I cannot take it to the borrowing cost. I cannot, because where this is going, it is going to P&L. This will also go to P&L. It is, this period is for P&L. This will also go to P&L. And here you will do it with the capitalization. You will make the same treatment. You will make the same treatment. Ankit, do you understand? Because this is the period when capitalization did not begin. Listen, he said that capitalization did not begin until March. When capitalization process will begin, only then interest expense and interest income will go there. You are still not clear.
No, I'm clear, sir. Actually, I'm seeing the capitalization method.
Capitalization began in March. Now you asked me, why did they create this rule? I can still go deep into it.
No, sir, that's fine. I think.
No, I tell you why. Because you know what? I tell you why. Imagine that I'll give you an example. Very interesting. Everybody would understand. Because otherwise I will manipulate with accounts. Let's suppose I take the loan in January and then I do not start construction. I start construction in July, right? So then 6 months I will not capitalize. I will start bearing the borrowing cost from July onward, 6 months. But then for 6 months I will take this interest income benefit. So I will make a very little borrowing cost expense. Otherwise I will manipulate. Because if you give me this freedom, that interest income you can take from the day one and interest expense only when you start doing the construction, then I can manipulate with numbers. I will extend this period like this. For here, I will take this period. I will not start the construction. I will take the loan, but I will not start the construction. So capitalization of expense of interest will come only in August. But in this all period, I will subtract 30,000 and I will say very little borrowing cost. Numbers can be manipulated otherwise. So what you should pay attention that sometimes students, they think that they have funds from January to June or July, whatever period. You do not have funds for that period for borrowing cost. You have to calculate for only 4 months. Only for 4 months. Those months where you actually started capitalization. Your capitalization of interest began in March. Your investment or interest income will also begin in March. March, April, May, June, 4 months. Remaining 2 months will go to P&L as interest. Okay,
so basically, the time where the construction started, this time we need to start to capitalize the interest cost.
Yeah, interest cost and interest income, both of them. They both will start there because that is a time when capitalization of borrowing cost begins.
Okay.
Okay, next question we see. Now that's also interesting. It has very one simple one word.
Sir, please, can I suggest something? It's good that when we reach one question like this, at least we should read the question. One person should read it aloud, or if it's possible.
Yes,
read it,
please
or
read
I can read it.
Yeah, please read question number 20.
Which one of the following will be recognized as an investment property under IAS 40 in the consolidated financial statement of Buildco? A, it says a property intended for sale in the ordinary course of the business. B says a property being constructed for a customer. C says a property held by BICO as right of use asset and leased out under a 6 months lease. And then D says a property owned by BICO and leased out to a subsidiary.
Okay, now let me tell you, IAS 40, it tells us that if you have a property which you are not using in your ordinary course of business, that is your investment property. Any property which you are using for your own business, that is tangible non-current asset, IAS 16. The difference between IAS 16 property and IAS 40 property, investment property, the difference is that under IAS 16 you are using for yourself. Under IAS 40, you are not using in the business, but you are using it for giving on rent or probably making some capital gains. You are essentially not using the property in the business. It is not for use. That is IAS 40 criteria. Now, option number 1A, property intended for sale in the ordinary course of business. This is not the answer because anything which you want to sell is your inventory. So this answer A, property, it should be treated as inventory because you want to sell it in the ordinary course of business. Whatever you want to sell in the ordinary course of business, which is your normal core business activity, then it is your inventory. So A is not the answer.
Sir,
B.
just one. Hello, sir. Can you listen me, sir?
Yeah, please.
Sir, a property intended for sale. So is it under inventory?
Yes, it will be treated as your inventory.
But it is a tangible asset, right?
Yes, it is a tangible asset. No problem.
Okay.
Inventory does not mean the items which are placed in the supermall, in the shopping center only. If you are a construction company, you make a building and you have 100 flats and you want to sell these 100 flats are your inventory.
Okay.
Do you understand?
Yes, sir.
You are a construction company. You make apartments. You make one big building which has 100 apartments. So these 100 apartments are your inventory. They are not your tangible assets, like non-current tangible asset. It is inventory. Inventory is also tangible.
Actually, sir, we sometimes get confused with these small things. We don't understand, the business that we are talking about. For a individual, a property is always a non-current asset. But
yes, but they are telling us that it is for sale. When it is for sale, okay, listen. Your assets, if you are, let me open up the video. I turned off the video because I was just having a smoke, and because you are recording this thing, so I don't want to smoke in front of students and that too on camera. I just finished my cigarette. Now I can turn on the video.
Sir, it's no problem. Smoking means we see people in office.
No, it's not good. It's unethical that I smoke and even I record it.
Actually, sir, I had one biology teacher in high school. If he comes to class where you're taking alcohol or smoking, that day we will get our best lectures.
No. Actually, number one, I tell you, teachers should not smoke in front of students. I believe that. I'm a very old-minded teacher. First, I would not like it that a teacher should smoke in front of students. And number two is that even if it is being recorded, it is not good. Okay, with you people, it's fine. You are boys. All three are boys. But still, I don't feel confident.
No, that's okay.
Okay, let me now
Okay.
Let me tell you. Let me tell you. See, you have a purpose for different assets. You need to see what is the purpose. Always remember. Your assets, you put money on asset. You spend money. And when you put money into business, you never put money that it is gone with you from forever. You always want to get back your money. So that is called recovering your cash. The word is recover your cash. So what is your intention? How do you want to recover your cash? If you want to recover your cash by selling the asset, you can only recover cash in two ways, either by selling the asset or by using the asset. So if you are recovering your cash by selling the asset, it is your inventory. And if you want to recover the cash by using the asset for a longer period, that is non-current asset. So first you should understand this difference. Like, you have this a car showroom, Toyota Center. Toyota Center brings cars from Japan, and they give $20,000 for one Toyota Corolla car, and they want their $20,000 back plus some profit. So how will they get their $20,000 back plus some profit? By selling the car for $22,000. So they will get back their $20,000 by selling. They will recover their cash by selling the asset, and selling the asset is their normal course of business. Normal course of business means this is their normal activity. So they will call their car as an inventory. For them, car is inventory. It is not about car. It is about the purpose. So for them, the car is inventory. And on the other hand, when you see you purchase that car. So when you purchase that car, you don't want to sell it. You want to use it. You want to drive it as rent a car as a taxi for 3, 4, 5 years, and you want to earn your benefits by using the car for 3, 4, or 5 years. So for you, now that car will become a non-current asset. So it's never the asset itself. It's the purpose of that asset which you talk about. Am I clear?
Yes, sir.
Okay. So if you say that the car, the purpose is to sell it, it becomes a current asset because it will be converted within 1 year into cash. It is intended to be converted within 1 year. You want to recover your cash by selling the asset. So that is your inventory. But if you say that I want to recover the cash not by selling, but by using it, so it becomes non-current asset. Under non-current assets, you have two standards. One is your IAS 16, which is tangible non-current assets. One is your IAS 40, which is investment property. Now, if you are using the asset within your own business, you call it tangible non-current asset under IAS 16. But if you do not use the asset in your business, but you give it on rent to someone, or you leave it somewhere so that prices will go up and I will sell it, then it is called investment property. I gave that example that you purchase 2 offices in the same building. One office on the 7th floor, one office on the 8th floor. And I ask you that, Ankit, this office on the 7th floor, what are you doing? You say, I am operating from here. I have a logistic company, freight forward company. I made my business here. So I'm using this office in my business. So I call it your tangible non-current asset under IAS 16. And then I ask Ankit, what do you do with the office on the 8th floor? You say, sir, I'm not using it in my business. I may give it on rent, or probably I will sell it sometime and make some profit. So that office on the 8th floor, which you are not using, is your investment property. Got it?
Yes.
Now that's the difference. Now, when you see the first one, option A, it says a property intended for sale in the ordinary course of business. This is inventory. Number 2, a property being constructed for a customer. This is your work in process. You are constructing a property for some customer. It is not even your asset. It is not even your asset. So it is your work in progress. Number 3, a property held by Buildco as a right of use asset and leased out under a 6-month lease. And a property owned by Buildco and leased out to a subsidiary. C and D are possible things, but there is a very little difference between C and D. D looks like an answer. D looks like an answer. It says a property owned by Buildco and leased out to a subsidiary, which means that Buildco is not using it. If Buildco is not using it, Buildco has given it to rent to someone. So it looks like an investment property. It could be an answer, but it is not an answer. It is not the answer.
The difference I can see is on the first line only. The first line of option D says it is owned by Buildco, means it's he's the owner. And in the C, it is held by Buildco as a right of use. Okay, if it is having only right of use, they cannot put it as their asset.
Okay, unfortunately, we have not done the leasing standard as yet, and we have also not done the consolidation as well. So probably that's why you people are not clear, but I will give you explanation. First, I'll explain D. D, it looks like investment property because D is your ownership. Like in D, Buildco is the owner, and Buildco is not using. Buildco has given to someone else. So it looks like that it is an investment property. So D is an investment property, answer C. But please pay attention to the question. In question, they played a trick. In question, they said that consolidated financial statement of Buildco. Consolidated. The word here, trick, is word consolidated. The trick is on consolidated word. Because if I am making financial statements of individual company Buildco, I will take option D as my answer. But if I'm making a group accounts, consolidation account, Buildco is giving it to one of its subsidiaries, one of its own companies. So it means for the group, the asset is still within the group. It is not being given out because you are making consolidated balance sheet. In consolidated balance sheet of the group, Buildco is parent, there is subsidiary, Buildco has given it to the subsidiary. For Buildco, it is an investment property. Buildco can call it investment property, but the group cannot call it investment property because for the group, the property is still within the group.
But see, I will call it investment property. See, if you see from the consolidation point of view, it's an investment property for parent, right?
No, parent will not call it investment property. Parent will call it, parent is using it. See here, this is, let me show you.
Parent is a Buildco here.
You know, that's why I picked up these questions because we need to do a lot of discussions. Buildco
and which
subsidiary.
Sorry, sir. Which year questions are these?
Sorry?
Which year paper these questions are?
No, these are from your practice kit.
Practice kit of DPP?
Yeah.
Okay.
Okay. So now what happened? You see, you've got here Buildco and you've got here your subsidiary. When Buildco gives this property to the subsidiary that you use it, or it is actually P company, let's call it like this, S company. Buildco gives property to S company. For Buildco, it is an investment property because Buildco is not using, it is used by someone else. S company is someone else. Buildco has given it to someone else. So you can treat it as investment property. But
Like
if you are
branch,
making,
teacher.
but if you are making your group accounting, when you make your consolidated financial statements, so group accounting is like this.
Hello, sir. आवाज सुन सकते हैं आप मेरी, sir? I'm really sorry for being the late in attending the classes. Hello.
Yes, I can listen you. Who is this?
Yes, sir. My name is Mohammed Aslan from Pakistan.
Aslan, you are in which group?
Ji, sir.
Are you
When
in
will you join?
F7 or F9? Which group are you in?
Yeah, F9, sir, F9.
Okay, Aslan, this is actually not F9 going on. We are doing F7. Probably Miss Annie has told you or not about the group timing. Are you on the WhatsApp group?
Yes, sir. Yes, sir. Yes, I have joined WhatsApp group.
So on WhatsApp group, we wrote that your F9 class was on Sunday.
But sir, मुझे बताया गया था कि classes 9 to 11 होगी according to Pakistan time schedule के according.
On Saturday?
Yes, I thought I can forget to have that. Sorry.
It should be on Sunday. Aslan.
Okay, sir. Thank you, sir.
I'll wait for you tomorrow. Okay.
Okay, sir. Okay, thank you, sir. Thank you.
Okay, so when you are doing for consolidated financial statements, you talk about the group accounting.
There is one more person who joined, I think.
No, only Aslan is there. Now we are only 3 people: Jabbar, Emmanuel, and you. We are 3 people here. Okay, so when you do your group accounting, in your group accounting, what happens that you make the group. Now, if you pay attention that even if the Buildco has given asset to S company, from Buildco it has gone out, but still the asset is within the group. So
These are
it is within the group. Asset from Buildco it has gone out, but it is still within the same house. Okay. Now you imagine here.
Teacher.
Yeah.
Like branch.
Yes, Jabbar.
Teacher, some company have branch in the many country. It's like that.
Yes, you can consider it, but it is not a branch. But for the time being, you can consider it as a branch. So this D answer, actually, that's why I said that, because we are using this word consolidated financial statements. We are talking about consolidated financial statements of Buildco. If they use, that's why we say D is not the answer. Because in case of consolidation, the asset still is within the business and it would be considered as used by the parent. Your answer choice is C. Answer is C choice. Let me talk to one more guy we have here. Shakib, are you there?
Yes, sir.
Shakib, I think there is some confusion. Please, I'm sorry. Can you write to Miss Annie on WhatsApp? There is some time clash. Probably, I don't know why or how did it happen that you are here at this time, because I'm doing now F7. So if you talk to Annie, she will talk to you about the time schedule. Yeah, Shakib.
Sir, I'm not here. Your son.
No, Shakib, I'm saying that if you talk to Miss Annie about the time, there is some confusion because I'm now doing F7 class.
Okay, sir.
Right. I'm sorry for this inconvenience, but please talk to Miss Annie that what is the timing, why did it happen that we have some conflict in timing. And I will also ask Annie to write you down now. Okay, she will write you in some time, or maybe you can write her. Okay. By the way, you can stay. If you want to learn F7, you are welcome. You can listen to us. We are doing F7. Your next step is F7, inshallah. So please stay with us if you want to. Okay, number 22. Please read this question. It is very simple and easy. And actually, we did 3-4 questions like this, so you should be able to do it.
Company has
Emmanuel, why don't you give me the answer for this question very fast?
I can only give you the procedure to get the answer.
No, you have to give me the number.
Okay, let me look for my pen and paper and see if I can calculate it.
So first you need to calculate your average cost of loan.
Yes, average cost of capital.
Average cost of loan, I'm calling it. And how much do you have? You have 140 divided by 340 into 10%, right? Plus 200 divided by 340 multiplied by 8%. So you got here, this is your cost of loan, okay? 8.8%. And it says on 1st of July, 2008, 50 million was drawn down for construction of a qualifying asset for which completed during 2009. So our financial statements are on 31st of December. We took out 50 million. So how do we capitalize? There is no interest income. There is only borrowing cost. So you will have 50 million multiplied by 8.8%. And how many months? How many years?
6 divided by 12.
6 months multiplied by 6 divided by 12. And you can just copy paste it here and put the equals to sign. You get the number 2.2 million. That's the answer. That's all. Very simple.
So this the text is using on numerous circumstances qualifying asset. What is this qualifying asset?
Okay. I'll explain. You are talking about this word. Qualifying asset means the asset on which you can capitalize the borrowing cost. So we know what is the concept. What we are doing? We are doing IAS 23. The standard is about borrowing cost, which means borrowing cost is what? Borrowing cost, we did the standard before, and if you watch the video, you would understand, but I'll just make a quick recap. Borrowing cost means that interest paid for the construction of some asset. Such an interest can be added to the cost of the asset. This interest will not go to the income statement as interest expense. It will not go to the income statement as interest expense. Instead, it will be added to the asset in the balance sheet. Do you understand? If I take out some loan for construction of some asset, and then I pay also interest on that loan. So what do we do with that loan? Usually the interest which you pay on the loan, it goes to the income statement as interest expense. But if you pay interest for construction of some asset, then this interest is considered as to be paid for constructing the asset, and therefore you can add it into the cost of asset. That's what we call borrowing cost.
Okay, sir.
Now,
So it looked like
the question is that what is the qualifying asset? Qualifying asset means an asset on which interest paid can be capitalized. Capitalized means that you can add it into the cost of the asset. So which assets you can do it? You
That
can
is
do
a
it.
separate standard for capitalization, like capitalization word we are also using. So
Yeah, there's IAS 23. There's a lecture on that. When you will go to the folder, there's a lecture named IAS 23 borrowing cost.
No,
So
capitalization.
only qualifying assets are self-constructed assets.
Sir,
Assets which you will make. If you purchase some asset, you cannot capitalize the interest. But if you make some asset, which means asset has to be self-constructed, should take significant time for completion. Now, when you will watch this video, it will be, I'm sure you have watched it, but when you do a revision, it will be better. But it should take, these are the two conditions which you call qualified asset. So when we say qualifying asset, it means that any asset on which interest I can add it into the balance sheet. Got it?
okay.
Okay.
Sir, I'm taking a note, sir. 1 minute.
Yes, please take. Sorry. Emmanuel,
Yes, sir.
because I know that you missed this lesson, and I made also a promise to you that I will explain. So I'm available for any extra lesson. Please go to the folder, watch this video, and after watching the video, if for some reason you do not understand, just ping me on WhatsApp and we can decide some 30 minutes. I will give you extra lesson. Okay?
Yes,
Okay,
sir, we
sir.
can move, sir.
Okay. Now we move forward. Okay, let me bring them down a little bit.
So I was saying that it looks like you'll be using most often the BPP kit because what I have is
I
the
use
Kaplan
BPP
kit.
mostly. BPP mostly.
And Annie gave me also the Kaplan kit. So already I made copies of the Kaplan kit, and that's what I'm using.
I will send you the BPP kit also.
Okay.
Sir, I don't have any kit, sir. Will you be sharing with me also? Or?
I will send you both of them. Just write it on the group, and Annie will send both kits.
Okay.
Okay. So number 23, please read it and we will do it.
So number 23 says, whether by purchase a machine on 1st July 2007 for $500,000 US, it is being depreciated on a straight line basis over its expected life of 10 years. Residual value is estimated at 20,000 USD. On 1st of January 2008, following a change in legislation, whereby fitted a safety guard to the machine. The safety guard cost 25,000 and has a useful life of 5 years with no residual value. Question: what amount will be charged to the profit and loss for the year ended 31st March 2008 in respect of depreciation on this machine?
So we have to calculate the depreciation. So here we have got machine, and then we have got the safety guard. You should remember that this safety guard, which you purchase later, it will also become a part of the machine. It will also become the part of that equipment because you never needed this safety guard. This safety guard was only needed to run this machine because it was a legal requirement. So now you can consider that the machine is 500,000 and also 25,000. This 500,000 machine, you will depreciate it like this: 500,000 minus 20,000, because 20,000 is your residual value. So this you will not depreciate. So what you are going to depreciate is 480,000 divided by 10 years life. So your 1 year depreciation on machine will be 48,000, right? This is your annual depreciation. And when I talk about safety guard is 25,000 value and it has 0 residual value. So it means that all 25,000 will be depreciated over a life of 5 years because it says safety guard has a life of 5 years. So now this is my annual depreciation for the machine and this is my annual depreciation for the safety guard.
Sir, in first line, we have said 500,000 minus 20,000. Your
residual value.
Okay.
Residual value means the value of the asset at the end of its useful life.
No, that's fine. But why we are reducing the residual value? Like,
because we don't depreciate it. We say that, Ankit, we say that an asset in the beginning is 500,000 and end value is 20,000. So how much you are losing on the asset? What is your loss on the asset? This 480,000, it is called depreciable amount. Depreciable amount means the amount in total which must be depreciated. So 480,000 I'm going to depreciate. It means that by using this asset for a period of 10 years, your 500,000 asset will become 20,000. So you will lose 480,000 over a period of 10 years. So in 1 year, you will lose 48,000.
Teacher, 20,000 is NRV.
No, it's not NRV. It's residual value. Residual value means the value of the asset at the end of the useful period of useful life. Like today when you purchase, it is 500K. But after 10 years, when you stop using the asset, its value will be $20,000.
But it's not market value, yeah?
No, it's the balance sheet value. Market value, we will see what it will be at after 10 years. We don't know market value today. After 10 years, maybe market value will be more, maybe market value will be less. I don't know.
Teacher, what is the meaning of safety guard? Safety guard is not depreciated.
Safety guard is some kind of protection device which you have put to the machine.
Yes.
It is some kind of protection. You know, when you purchase a refrigerator or maybe something else, you purchase some stabilizer or something like this.
So actually, this safety guard, we use it to protect maybe any rotating part of the machine.
Probably
because
yes.
it protects us from coming in contact with this rotating parts. Any
yes,
machine, any machine which has rotating parts, we put safety guard there to act as a barrier between the machine and humans.
Right. So the point here was that what you need to do, that your asset was 500K. After you using 10 years, it becomes 20,000. So asset is losing 480,000 in value. And this 480,000, when you divide over a period of 10 years, annual depreciation is 48,000 per machine and 5,000 for the safety guard. But in our question, the issue is that we don't talk about annual now. Because when did you purchase the machine? When are you making your financial statements?
31st of March 2008.
Machine was purchased on 1st of July 2007. So how many months? 9 months for machine, right?
Yes.
So we put here as 48,000 multiplied by 9 divided by 12. And then safety guard, when did you purchase the safety guard?
3 months back, like in January.
So you've got 3 months here for that. January, February, and March. Because your year is ending on 31st March. So January, February, and March. So I put here 5,000 multiplied by 3 divided by 12.
So if our year end is 31st March, it means our starting year will be
1st of August.
February.
Yeah, no, 1st of April.
1st April.
1st April.
1st of April. Okay, we take the money in front. Okay.
Yeah. So 37,250 should be your answer. This is the depreciation for these two.
Yes.
Okay, this was actually easy one, but we just got into some kind of discussion. But it was.
But teacher, I am a little confused about 20,000. I didn't.
Which 20,000? This one.
Residual value. Yeah.
Yeah, Jabbar. Residual value is the value of the asset at the end of its useful life. You know, you purchase a car for yourself for $20,000, and you start driving your car. After 5 years, will your car become zero?
No.
It will have some value.
Yes.
Approximately how much? Just a guess.
2,000.
2,000?
Yeah.
So much value? You mean 20,000 car will become 2,000 in 5 years? Are you sure?
20,000 means what, dollar?
Whatever. Makes no difference.
Okay.
I don't think in Afghanistan, a 20,000 car, or in India, Pakistan, in these eastern countries, in low income countries like Pakistan, India, and Afghanistan, used cars, they are very much in demand. They have a lot of value.
Yeah, so I think only depreciation, that maximum depreciation that I can assume is 10 to 15% on the car, 15% basically.
So I think that a 20,000 car, let's suppose that you purchase a 20,000 car today. So today it is 20,000. And you assume that after 5 years, your car value will be, say, I don't know, 12,000, or let's call it 8,000. So how much you are losing on car? What you are losing?
12,000.
So this one, after 5 years, this one is called residual value. This is your initial cost. And this 12,000 is called depreciable amount. So you make a loss of 12,000 while using this car, and this loss will happen in 5 years. You did not incur this loss in 1 year. Your useful life. In years, useful life in years. So in 5 years, you incur this loss. When you are using this asset over a period of 5 years, the asset will lose $12,000. So it means that every year, it is losing $2,400. This is called your depreciation per year. Residual value which you expect it to be after 5 years. I give you another question. Jabbar, if you purchase a printer today for $100, do you think you can use this printer for the rest of your life?
Yes.
For the rest of your life, can you use a printer?
No. For some years we can use.
Maybe you can use the printer for 3, 4, 5 years, right?
Yeah, every asset has a life.
So if today this printer is $100, what do you think? After 5 years, will it have some value? I think zero. You will just throw it out.
Yeah, when it's zero, it must throw out.
You must throw it out because printers do not have. Nobody will purchase a 5-year-old printer from you. After 5 years, it's an old printer. You just throw it out. So the printer will have zero residual value. Residual value is the value which you assign to an asset at the end of its life.
Yes. Now I get it, teacher.
Okay. So let's see this one more question. This is a little bit more interesting and technical. Last question.
Can I read it?
Yes, please. My pleasure.
Qatar vacated an office building and let it out to a third party on 30th of June 2008. A cost of $900,000 on 1st of January 2010 and was being depreciated over 50 years. It was judged to have a fair value on 30th June 2008 of $950,000. At the year-end date of 31st December 2008, the fair value of the building was estimated at $1.2 million. Qatar uses the fair value model for investment property. Question: what amount will be shown in revaluation surplus at 31st December 2008 in respect of this building?
So how much is the revaluation surplus? Now, let me first tell you what is happening. You purchased asset on which date? 01/01/2000, okay? You purchased asset on this date. And what was the cost when you purchased? 900,000. Life is in years, how much?
50 years.
50 years. So how much is your depreciation?
18,000
per year. This much. 18,000 is your depreciation per year. Okay. Now what happens? It says that you took this asset, you started using it, and you started charging depreciation. Starting from 1st January 2000. It says that Carter vacated an office building and let it to a third party on 30th June 2008.
Yes.
When did you vacate office? On
30th of June 2008.
2008. So if you talk about 30th of June 2008, how much period has passed from the beginning until here?
7.5 years.
8.5 years.
8.5 years, yes.
2000, 1, 2, 3, 4, 5, 6, 7, 8. 2000, yeah?
8.5, yes.
Say 8.5 years. So how much depreciation you have charged? Depreciation until?
153,000.
Depreciation until 2008. How do I calculate it? I will calculate it. 900,000 divided by 50 multiplied by 8.5. Agreed?
Yes, sir.
Yes.
Because it is 8.5 years life. So 153,000. You will say original cost 900,000. Net book value at. So this date when you vacate this office, when you leave this office, the net book value of the asset is how much? 747,000. So do you understand my point? What I'm doing?
Yes, sir.
I got the office for 900,000. I depreciated it for 8.5 years. So my asset is 900,000. My depreciation is 153,000 for 8.5 years. So my net book value on the date of vacation, 30th June 2008, was 747. And what did we do? We revalued the asset. How much we revalued? What was the value on this date?
The revaluation value of 950,000.
Great. So it means that how much revaluation you did?
203,000.
203,000, you did revaluation. So the increase in the value was 203,000. This is one point you remember. Now, this is about 30th of June. Then you go up. And what happened? That on here, you left the property. Now you should remember that until this point, this asset, you were using the asset, and it is being treated as tangible non-current asset under IAS 16. Under IAS 16. Do you understand my point? Because you are using the asset, and this is what we told you, that if you are using the asset, it is your IAS 16. On 30th of June 2008, you gave it on rent, which means stop using it. Yes. So now it is classified as IAS 40 investment property. Are you clear with the scenario?
Yes, sir.
Yes.
Because
Yes,
on 30th of June, you gave it to rent to someone else. It says that you vacated the office and let it out to a third party. Let it out means you gave it on rent to someone. A third party, you gave it on rent. So after 30th June, it will be considered as investment property. So on 30th of June 2008, the value of asset is 950,000. And then on 31st of December 2008, the value of asset is 1.2 million. Yes? So there is
yes, sir.
fair value of the asset. So it means that there is some difference. How much is the difference? Difference is 250,000. You made a gain. You made a gain on this asset because on 30th of June, the asset was 950,000. But on 31st of December, the asset is 1.2 million. It means that there is some gain on the fair value, gain or loss on fair value. So we've got a gain on fair value under IAS 16, under IAS 40. Am I clear until here?
Yes, sir.
This is for
Yes, sir.
6 months period. This is for these 6 months. Now, what is the question? The question says, what amount will be shown in the revaluation surplus at 31st December? Now, I've got two amounts. 2 times the asset is increasing in value. Asset increases in value at this point, and then asset increases in value at this point. These are the two increase in the value of the asset. Are you people with me?
Yes, sir.
Yes, sir.
Yes.
Now, what do we do? Which amount we take where? The rule is, I'm writing down, and I explained it in the video or lectures as well. Gain on IAS, gain under IAS 16 goes to revaluation surplus. Gain under IAS 40 goes to profit and loss. When you make gain, if you make a gain, when I was doing that impairment, if you remember impairment, I told you,
Yes, sir.
impairment, go back and watch that video of impairment. I said many times that impairment of tangible non-current asset go to other comprehensive income. Impairment of investment property go to P&L. If you have an investment property, IAS 40, its value goes up or value goes down. You write it into profit and loss. But if you have a tangible non-current asset, the value goes up or the value goes down, you put it in OCI, other comprehensive income. Now they ask us the question. In this question, they are asking us that what amount should be shown in revaluation surplus. So what should be the answer?
203,000.
203,000 will be the answer.
Sir, one question. Why do we charge any depreciation on investment property also?
No. Investment property, we never depreciate. Investment property, like from this period, last 6 months, you will not have any depreciation. Because on 30th of June, you made this asset as investment property, you will stop charging depreciation. There is no depreciation for investment property. Investment property, you will only see the fair value. Any increase or decrease in the fair value will go to the income statement.
Okay, sir. Thank you.
Now, I ask you, is it clear until here?
Yes, sir.
Okay.
Yes,
If I
yes,
ask
sir.
you, how much depreciation expense will go to the income statement for this asset? Can somebody tell me? In 2008, now they did not ask us, but let's suppose that 2008 depreciation expense should be how much?
2008. So we have 6 months of depreciation that is being charged. So 9,000, 18,000 was the yearly depreciation, 9,000.
Yes. Listen, if this question asks you how much depreciation in 2008, so in 2008, the first 6 months you were using the asset. The next 6 months you gave it on rent. The last 6 months it became investment property, no depreciation. In 2008, your depreciation expense will be only for first 6 months. First 6 months. And how do you calculate first 6 months? 9 million divided by 50, multiplied, and then divided by 2 further. It is 6 months because 50 years and you make it 6 months. 9. What did I do? I put one more zero maybe. 1 0 was more. 9,000. This will be the depreciation expense for the 6 months. Am I clear?
Yes, sir.
So just remember these rules. Just remember this rule. I'm putting it in bold. Okay. Any question until here, please?
No question, teacher. It's clear.
Listen, yeah, I tell you, I'm fully committed with you people to how to say, you know, I never like when students say that I'm taking exam in December. No, you are not taking exam in December. You are passing exam in December. In my dictionary or in my life, failure is not an option. No, you have to pass. There is no other thing. And we will do whatever it will take to make you pass. I felt now, let me stop the video first.